Welcome, everybody. My name is Michael, and today I am still dealing with a fever from yesterday, so don't mind my energy levels. We are discussing about the collapse of the crypto giants, the crypto companies that are falling like flies, and some of the similarities to 2008 bailouts and the recession. So, with that said, let's discuss why crypto exchanges are falling insolvent left and right, and some of the reasons for the general crypto crash, and how we can avoid repeating the same mistakes, although we've already done this, and in some ways it's worse than in 2008. So let's go on this journey. Thanks so much for staying tuned. Let's get into it. So, one of the main reasons behind the crypto collapse is the greed of a couple of companies and the lack of foresight. So, this all began a little while back. Of course, there's the macroeconomic events outside of crypto that also had definitely an impact. But inside of cryptocurrency, there is a company called Luna, and then they have another token called Terra. UST is its stable coin. There has been a lot of controversy regarding stable coins, and a lot of people think that if further larger stable coins collapse, it will definitely lead to hundreds of millions of dollars additionally that will be decimated, where already we've had over $2.2 trillion removed from the market cap of all cryptocurrencies. Now it's around 800 million. So you have Luna and Terra, altogether $40 billion market cap, where Luna is minted every time you are withdrawing cash from Terra. So if you're suddenly switching from one crypto to another because, say, the market is turning a little bit bearish, then at that point, Luna would be minted as part of its algorithm to maintain stability. The problem is when US Terra was depegged. So anytime a stablecoin that is supposed to be close to $1 gets depegged, meaning it goes down to 90 cents, 80 cents, 50 cents, in this case, it went down all the way to 30 cents, you have a massive difference where people are going to freak out, and suddenly the amount of Luna that was being printed off went through the roof. So as there was increased demand for selling US Terra, the price of Luna remained at $1, and this was constantly being minted out, where the price of Terra went down to eventually 30 cents. So that caused a massive period of inflation for a coin where suddenly it wasn't worth that much anymore, and people wanted to get out of it, and within a matter of a couple of days the whole market collapsed for Luna. So the founder, Do Kwon, obviously he knew about the shortcomings of Luna, and there was reports that he was even selling months beforehand $80-90 million of the coin to fund his own pockets. So definitely could have had a better reaction. There was a lot of degenerative over leveraging from all of these companies out there, and Luna was the first domino to fall, and suddenly you had other companies that were massively over leveraged that couldn't handle it, and eventually they had to shut down, and their own clients were the ones that were affected later on. So you had an increasing amount of Luna that was minted, and eventually it would become worthless, falling both UST and Luna. And then they had another token that was supposed to help those victims of the crash, but that crashed too. So next we move on to the second domino, Celsius, which we've heard a lot in the news recently. Celsius was a company that was had a total amount of assets that was anywhere from 11 to 18 billion dollars. Now, when the balance sheets were looked at by FTX, by Sam Bankman-Fried. So Sam Bankman-Fried owns FTX and Alameda Research, and he's basically the man behind the bailouts for BlockFi and Voyager. They were also taking a look at originally Celsius, but they realized that Celsius wasn't worth what they were portraying to be. When they took a look at the books, they said, no way, we're not purchasing Celsius. We don't want anything to do with Celsius. However, However, now you have Goldman Sachs that over the past week they've announced that they're looking to raise $2 billion of capital to potentially purchase Celsius. So it's basically a fire sale for the company. So they didn't get a bailout. They were ignored by FTX, but there's still hope. However, with that, they were basically like the Lehman Brothers of 2008. The most over-leveraged guys on the block, the ones who fell first, essentially. With Lehman Brothers in 2008, the reason they went bankrupt before the other banks were bailed out was, first, the government didn't realize that bailouts would be necessary to support the ecosystem. They wanted to wash their hands clean. However, when Lehman Brothers fell, the reason it fell so quickly was because they were over leveraged, just crazy amounts, 31-to-1 ratios, which means for if it was, for example, 2-to-1 ratio, if it goes up 2x, you have the chance of doubling your profit, or you also have the chance of doubling your losses. If it goes up if it's 31x leverage, then that means just a small movement in the market can liquidate everything. So Celsius essentially was a high risk, high interest trading company where suddenly, after Terra Luna, the fiasco that caused $40 billion to be evaporated, you had a bunch of companies that were impacted by that. And also you had a ton of very big influential people that also lost money due to that. Even Binance lost $1.6 billion. So with the Luna Terra fiasco, as soon as that happened, Celsius stopped trading. And they didn't want to admit that they had their money in Luna Terra, but it is definitely what occurred. They basically were in a special program for very high interest rates, but obviously higher risk at that point, called the Luna Terra's Anchor system. So as soon as Luna fell down, then you had a ton of companies that if they were over leveraged with Luna, they couldn't support the rest of the ecosystem and they had to stop withdrawal. As of June 13th, Celsius has not resumed their withdrawals or any transfers. The next domino was 3AC, which we've seen all over YouTube. Three Arrows Capital was a large Singapore-based hedge fund that had definitely overexposed themselves to Terra and Luna. The reason for that is after the fiasco, they were unable to pay other debts that they had. So they defaulted on money that they borrowed from others, such as Voyager Digital, such as BlockFi, which later led to both BlockFi and Voyager Digital going essentially almost close to insolvency, and they had to be bailed out. But Three Arrows Capital did go bankrupt. They filed a Chapter 15 bankruptcy, which is for foreign companies. And then you have the two main players of the past 2 weeks. You have BlockFi and Voyager Digital, and this is where Sam Bankman-Fried comes in. Sam Bankman-Fried is a multi-billionaire. He has a lot of power. FTX and Binance, Changpeng Zhao and Sam Bankman-Fried are the big boys in crypto. And they are trying to help out the companies that they can because they have their own interests at stake here. So now we come to Voyager Digital, BlockFi, and even CoinFlex, which we've made videos about all of that over the past week. With CoinFlex, that was a exchange that basically all three of these paused, apart from BlockFi, paused withdrawals, transfers, trading. It's very murky territory right now. With Voyager Digital, they had over $4 billion in assets, two of which were lent out. Out of those that were lent out, again, which is customer money, you had almost $650 million that was inside of 3AC, which 3AC was affected by Terra Luna. So as you see, it's like a little domino effect. Now Voyager Digital, since they're unable to get paid by 3AC and BlockFi, unable to get paid, they were going to go insolvent. So all the customers, all the money that was inside Voyager Digital recently stopped withdrawals, transfers, pretty much anything that's happening. And BlockFi and Voyager Digital were saved by Sam Bankman-Fried. And now BlockFi has been rumored to be, this happened. We don't know the exact amount. This is anywhere from $25 to $270 billion, their valuation for a company. For a company that was worth a couple $1 billion not too long ago. So they were acquired, and with Voyager Digital, there's rumors that potentially they could be next to get acquired. If not, they had a $500 million bailout presented by Alameda Research with BlockFi and Voyager Digital. A total of $750 million was basically lent out through this bailout with both Sam Bankman-Fried's FTX and Alameda Research. So all three of these exchanges might go down. CoinFlex even though we don't know essentially if they were involved with Terra Luna, they are missing $47 million from Roger Ver, which Roger Ver overextended himself for a BCH long, and potentially he was either impacted by Terra Luna or he was impacted by just generally the market falling down thanks to the Terra Luna fiasco. He was unable to pay him back, and CoinFlex is unable to pay back its customers, so they had to shut down withdrawals. So now this leads us to the other part of the equation, why this is all collapsing. You have grayscale Bitcoin, and you have Ethereum 2.0 coming up with staked Ethereum. And even though everybody's saying, well, staked Ethereum by the end of 2022, the withdrawals aren't going to happen up until 6 months after launching, that is true. There is a current discrepancy with ST Ether and with GBTC. You have a discrepancy in pricing. So what's supposed to be pegged essentially, so this is similar to a stable coin, it's tagged to $1, just like USDT. Tether is pegged to $1. You have GBTC, which is supposed to be pegged to the price of Bitcoin. Well, that suddenly had a difference of up to 31%. And then you had ST Ethereum. So you had a staked Ethereum token, which went up to a difference of 7 or 8% from the actual price of Ethereum. It's, again, not supposed to happen. So you have a resultant risk in the system from duration mismatches. Now, technically, ST Ethereum wasn't depegged, as some would say, because it never was pegged to Ethereum. There was a reason for it to fall. That's with an old exchange, CEX. This is more used by Europeans, but CEX was kind of in a gray area with ST Ethereum. So just like 2008, you have a number of companies that are receiving bailouts, except unlike the Fed, FTX and Binance have a limited number of funds. So some speculate that if this were to continue, then there could potentially be problems if the companies that they're buying end up like junk. For example, Voyager Digital completely goes away for whatever reason, the funds get lost, and in this case, SBF, Sam Bankman-Fried, would lose a ton of money on this deal. So back in 2008, AIG got a bailout, the big mortgage company. You had Fannie Mae and Freddie Mac. They were bought out by the government and bailout at that point. You had other big banks that were purchased, big investment banks that were purchased at a discount, like Merrill Lynch being purchased by Bank of America. And you had Lehman Brothers went out, Bear Stearns remained. They were purchased at a huge discount by Chase, and Washington Mutual also was purchased by Chase, and both Bank of America and Chase were too big to fail and received bailouts, and there was bailouts all over the place. And the damage has been done, and it was never fully fixed. So you have a ton of crypto companies right now that shouldn't be being revived. If they're going to fail, let them fail, because it might bring down other companies that are larger, and in these cases, they might just be too big to fail in the crypto space. Can you imagine the fallout of what would happen if Coinbase, Binance, the big boys, FTX, all of these exchanges started having withdrawal issues? And in the terms of service, they have the exact same thing. The average user, unless you are an accredited investor, someone who's investing in the company directly, or you have some ties to it, you're going to lose all your money. It's not FDIC insured. You're going to lose hundreds of thousands, potentially millions of dollars. And this is across millions of users globally. So at the end of the day, these companies need bailouts because they were investing in funds that weren't there. They were the investors. In order to provide these high yields to their investors, the customers, they lent it out for very risky stuff, which as soon as the first domino fell, the rest started going down as well, because they put all their eggs in the same basket. They weren't diversified enough, and eventually one of the big boys fell down. You lost a couple $100 million. You can't pay back your investors, and there we go. Another exchange will fall down after you. Thanks for watching, guys. Have a great rest of your day.